Did you know that today there are two ways you can use your life insurance policy without actually having to die? I mean, historically speaking, about 99% of traditional term life policies never pay out a death benefit. And I don't know about you, but that sounds like a big fat waste of money if there's only a 1% chance that sucker could pay out. Now, mainly that's due to them either letting these policies lapse or just simply outliving them. But nowadays, there is a new kind of life insurance on the block that allows you to access not just the death benefit of the policy, but also a cash value component while you are alive. And that's called permanent life insurance. Or more specifically, my favorite is an index universal life. Now, an IUL is just a permanent life insurance policy that has two features that allow you to access that policy while you are alive. And the first one is called living benefits, which are just riders that can be added to life insurance to access the death benefit while you are alive. Most IUL products carry these, and nowadays you'll see them in a lot of term policies too. And here are the three kinds of living benefits. The first one is critical illness. This means if you get diagnosed with anything pretty severe like heart attack, stroke, or cancer, you may be eligible to receive a portion of that death benefit while you are alive. And this is great because that money could be used for anything, to pay for medical expenses, to simply pay your mortgage, put food on the table for your family while you are recovering. Now, the dollar amount that you receive is going to be based on the severity of the illness or the injury that you have. The next one is chronic illness, which means if you cannot perform 2 of the 6 activities of daily living on your own, then you might be eligible to receive a portion of your death benefit every single month. And again, this can be used to pay for medical expenses, home health care assistance, or assisted living facilities. And the third one is called terminal illness, which means if you get diagnosed with 12 to 24 months or less to live, depending on the insurance company, they can accelerate a significant portion of the death benefit, 75% or maybe up to 90% of it, for you to have while you are alive. This could be used to pay for any last-ditch efforts in pending treatments, for any travel, or just any final wishes that you have to spend with your family. Now, keep in mind, depending on the state that you live in the United States, the living benefits that are offered could vary, potentially drastically. For example, if you live in the United States, it's one of the most strict states for insurance companies to get new products and features approved, although I have one insurance company on my platform that offers all 3 living benefits in the state of New York. And if you live in other states like California or potentially Oregon, there are also difficult states for insurance companies to get living benefits approved. But I have carriers on my platform that offer all 3 in all of these states. Now, the second way you can use your life insurance while you are alive is called cash value. And all forms of permanent life insurance have this, including IULs. So how it works is you pay your monthly premium, and a portion of that premium is going to spill over into your cash value account that will grow tax deferred. Why I like IULs is I feel like they do this the best because they put your cash value indexed to the stock market, meaning you're going to get the growth when the market does well, but the insurance company assumes all the risk. So when it doesn't, you don't lose money. But here's what makes this so powerful. Because of the life insurance, you can actually borrow from your money tax-free. So you can get to your contributions plus the interest that it earned, all tax-free through policy loans. And this is so powerful. People use it for so many different ways: to build an emergency fund, to buy a car, to start a business, to buy real estate, and even pay for college. And in my opinion, borrowing money from your life insurance policy versus a bank is a better idea for 3 main reasons. And the first one is no credit checks or approvals, meaning you can get access to money for anything that you need. You don't have to worry about sitting down in front of a banker and trying to look good so that they'll give you a certain amount of money for X, Y, and Z idea. It's your money. They'll give you access to it for anything that you want. And it doesn't show up on your credit report. Number 2 is there's no repayment agreement to it. There's no banker telling you have to pay that loan off by X, Y, or Z date. Now keep in mind, if you fully deplete your account, you will definitely want to start making payments back on this loan so that your policy doesn't lapse. But realistically, as long as you're smart with how you do it and you don't take everything that's available to you on a loan, there really is no repayment terms to it. And if you were to die with an outstanding loan, the insurance company would just deduct whatever you owe them from your cash value, and the rest just transfers to your family with a death benefit, all tax-free. And 3, you have the ability to earn what's called uninterrupted compound interest, which means when you have cash value available inside your account, you don't actually have to deplete it. The insurance company can look at that and use it as collateral, loaning you their money instead, allowing your money to stay inside your account, growing and earning interest. And like I said earlier, if you die with an outstanding loan, they know you're good for it because they see it's available inside your cash value account. They'll just deduct that and pay your family whatever's left as a death benefit when you die, all tax-free. Now name me one other financial institution that pays you if you get sick or injured, pays your family if you die too soon, and pays you in retirement if you live throughout your golden years. Now, I know this all sounds great, but it's not too good to be true because there is an approval process to it. Every insurance company is going to take a look at you. They're going to look at your age, your health history, and your criminal background. And if you don't sound too risky, they'll place an offer for you to come on board and own one of these products. Now, assuming that you can get approved, it might be a fantastic account for you to own. I just recommend before you do anything that you sit down with an IUL specialist like myself to help guide you through the questions to see if this account could make sense for you. I have linked 2 videos here for you to do your own research and learn a little bit more. And as always, make sure you subscribe so you don't miss another video teaching you about some cool things you can do with your money. And I'll see you back here next week on YouTube.